get in line with the safe harbor right now. Move your lots over to whatever wallets you need for your cost basis for 2024, and then just have a plan in place for 2025 and beyond for how you're going to be moving those assets across. Because likely scenario, you probably have a lot of assets that are in cold storage that have a very low cost basis. You want to keep them in that wallet. But if you do want to dispose of them, it might be smart to move them into an exchange account.
The IRS revenue procedure is quite broad. They said we will accept any reasonable allocation of basis amongst these subledgers. So to me, the key thing is to tie in your ending year-end balance with the start of the subledger.
Welcome to the Accountant Quits podcast, where we help accounting and finance professionals learn how to manage a business using crypto. Today's topic will be an update on crypto taxation in the US. Donald Trump's presidency is stirring up buzz in the Web3 community. Builders and users alike are optimistic about how the new administration will shape the future of digital assets, with promises of clearer regulations and greater adoption of cryptocurrencies on the horizon. But while we wait for these changes to take effect, there are already some major tax updates you need to know of. So in today's episode, we'll dive into important topics that every US CPA and taxpayer involved in crypto should be aware of, including the new reporting requirements for digital assets from the IRS and the safe harbor relief, the domiciliation issue when earning staking rewards, how to value airdrops, the tax implications of token migrations, updates on DeFi regulations in the US, and more. And to help us navigate these complex but important updates, I'm thrilled to welcome back RSM US, one of the largest accounting firms in the world and a leader in digital asset space, with some of their Web3 clients including Ondo, Stellar, Binance, Paradigm, Bitgo, and Consensys. And joining us today are Skip Carlson, Digital Assets Market Leader at RSM US, and John Cardone, their Senior Tax Director. RSM provides accounting, audit, and tax services for digital assets, is represented on the AICPA Digital Assets Working Group, and are actively providing specialized training to their new hires on everything related to blockchain accounting and tax. Lastly, if you're new to this channel, I'd really appreciate your support to help us grow by liking this video and subscribing. Now enjoy my conversation with Skip and John. Skip and John, welcome and thanks for taking the time to be here.
Thanks for having us.
Before we dive into the accounting and tax topics, could you both share an intro about yourself and your respective roles at RSM today?
Sure, I can go first. Yeah, Skip Carlson. I'm the market leader for the blockchain and digital asset practice at RSM. That really means I lead sales and go-to-market strategy, helping to find the right subject matter experts to solve our clients' needs, understanding the technology, how they're using blockchain, how they're transacting in digital assets, but just understanding their business models and how we can support them, and then just being with them through the client journey as we move on to a successful engagement.
My name is John Cardone. I came to the RSM about 3 years ago after spending 20 plus years with the government, in particular with the IRS, running different sorts of tax administration and enforcement programs. One of the last things I was doing at the IRS was their digital asset program, which had started out as an offshoot of their offshore compliance programs, which I was running at the time. So I concentrate basically on all kind of tax issues involving digital assets, information reporting, and IRS compliance efforts and programs with respect to digital assets.
All right, to start our conversation today, I want to go through the safe harbor relief. So in 2024, the IRS issued the Revenue Procedure 2024/28 to provide taxpayers a safe harbor to assist in transitioning from the universal wallet approach to the multiple wallet tracking. Now, I want to provide some context to the listeners. So back in 2014, the IRS issued guidance that digital assets are treated as property for tax purposes. And just like any property transaction, you then have to track the cost basis to recognize gains or loss upon disposal. So Under the current guidance, taxpayers can track the cost basis of their digital assets as if they were held in a single wallet address. Hence, the term being used, universal wallet approach. Just to give you an example, if I held ETH across several non custodial wallets and exchanges, at the time of disposal, I can aggregate the cost basis across the entire pool of assets and exchanges. But that's no longer allowed from January 1st, 2025. And based on the feedback I've had, most people use universal wallet method. So multiple wallet tracking or account level tracking, it is a significant change to how digital assets transactions must be reported and tracked for tax purposes. So I want to start with this major change. And could you please share with the listeners what they need to be aware of around this new safe harbor relief?
John, you want to lead off?
Sure. As you correctly summarized, the state of the guidance before the release of the regulations and the safe harbor, this 2024-28, this revenue procedure, was a piece of companion guidance that was issued with respect to the reporting regulations. And the IRS really made it clear, in general, they never want taxpayers at the end of the year to retrospectively reconstruct their records or determine the tax liability with hindsight. So the IRS kind of made it clear that you need to establish a kind of a wallet level approach to accounting for your digital assets. You can still use a variety of accounting methods. You can still use HIFO. You can still use FIFO. You can still establish practices for selling high basis sales, but that has to be done at the beginning of the year, established at the beginning of the year, and then stayed with it throughout the year. And that needs to be documented. For most taxpayers, if they were operating on an exchange, they don't really have to do anything. But as you said, if you were self-custodying your assets and you were using this universal wallet approach, you need to be a little more disciplined about your accounting and your sales practices so that you are tracking each sale or tracking your sales by wallet and you're using a consistent method, whether it's HIFO or FIFO or some other specific ID.
Yeah, and just to add on to that, it really depends. Your situation depends on what type of crypto holder you are. If you're just a retail investor who has a couple wallets and has some funds on some exchanges, you probably have an easier time tracking your lots and your cost basis across your wallets. We also have clients who have hundreds of wallets for varying different purposes. Some are trading accounts, some are operational, some they just hold in cold storage. We've been working with them through the safe harbor period. One, to make sure they've done a good job with specific ID, spec ID, to understand what their specific basis is for each of those assets, where they're allocated across their wallets, and then, as John alluded to, doing a little better job of foresight into their inventory management of where they want those wallets to be, what they're going to use those wallets for, moving the assets into the right wallets right now during safe harbor. And for most folks in the space, if you've been using a decent subledger over the past few years, you probably have a pretty good idea of your basis on most of the assets you purchased. Sometimes it's not so straightforward depending on how much volume and trading you've been doing. But really, it's get in line with the safe harbor right now. Move your lots over to whatever wallets you need for your cost basis for 2024, and then just have a plan in place for 2025 and beyond for how you're going to be moving those assets across. Because likely scenario, you probably have a lot of assets that are in cold storage that have a very low cost basis. You want to keep them in that wallet. But if you do want to dispose of them, it might be smart to move them into an exchange account. So it all depends on your situation, but we've been working with many private clients and institutional clients across the space.
Now, I have a follow up question on how the IRS defines what a wallet is. So, they actually define it as a means of storing a user's private keys. But most people think of wallets as addresses, right? So, to give an example for the listeners, if I take my MetaMask wallet, I can create 100 different addresses. So, is the multiple wallet tracking method telling me to track these 100 addresses individually or rather for that single wallet? Could you share your understanding of this? Because I know the IRS is not very clear on.
Yeah, you gave a perfect example with a single MetaMask private key being able to access multiple addresses. And you're right, the IRS has not opined on how they define a wallet. We feel you likely don't need to address it at the address level, just at the wallet level. So that one private key you have that accesses multiple, you should be tracking on just a per wallet basis, not a per address basis. But be curious to get John's thoughts on it as well.
Yeah, I would agree with that. I think there's sometimes when really business common sense, for all the criticism the IRS takes, they do recognize that it really just doesn't make sense to track at the address level when there could be hundreds of addresses in basically one utility wallet that's used for operations. I think the wallet level, what they're really looking at is the character of the activity going on in the wallet, and are you being consistent in tracking that activity? As Skip mentioned before, if it's an operational wallet, if you're using a bunch of different change addresses, they're not going to be worried about that as long as the character of the activity is really the same in that wallet and you're consistent in how you're accounting for the transactions.
Now, to prepare for this transition, a lot of our listeners already using subledgers or tax tracking tools. I've seen a lot of the subledgers out there already informing their users that their software is ready for multiple wallet tracking. I want to ask you, for the listener, what should they be paying attention to their subledger, or in other words, what they have to ensure the subledger is providing them for multiple wallet tracking?
I think now is really a unique time where hopefully most taxpayers have their ending balance of their basis in their digital assets. And you want to take that number and distribute it as appropriate amongst the subledgers. The IRS revenue procedure is quite broad. They said we will accept any reasonable allocation of basis amongst these subledgers. So if I have 100 units in a ledger, I'm sure the IRS would accept it, and the aggregate basis is in there. You could reasonably allocate the assets ratably amongst those 100 units if the source basis is trackable. So to me, the key thing is to tie in your ending year-end balance with the start of the subledger. If that requires you to manually enter in basis for your systems going forward, now is really the time to do it. You don't want to have to try and go back and do this in December of 2025.
Yeah, agreed. A lot of the sub ledgers out there do a good job of automating this, but not all of them are going to catch it perfectly. So just make sure you're going back and manually tracking and putting in that basis, which you might have to do.
Now, before we move on to the topic of delegated staking, a few weeks ago, the IRS issued some new regulations describing the services that will trigger broker reporting requirements for users of decentralized trading platforms, referred to as TD 121. Could you go through what these new changes mean for these DEX and also what it means for DeFi participants for the 2027 and 2028 reporting periods?
Sure. Hopefully, the effect on DeFi participants won't be any different from the reporting that normal custodial brokers are receiving. But what the IRS did in December, right before Christmas, was issue the final piece of what they consider to be someone who's facilitating trading services. Earlier in June, I told people if you're a broker and you serve as an on and off ramp to DeFi, or you redeem your own coins, and you basically take custody of the assets, you're a broker. Now what the IRS is also saying is if you are a front-end service provider, if you are a bridge for someone to get into traditional DeFi, then you potentially are a broker. And the IRS laid out basically, to boil it down, is if you're making money off the transaction, then you better look carefully at these regulations, because if you're providing service that's helping someone get into a DeFi product and actually execute an exchange, regardless of whether you take custody, then you better look at these regulations because chances are you are a broker. And the IRS laid out tests of whether or not you can amend your terms of service, whether you can charge fees for this product, and whether you can monitor whether the person actually executed the trade. So this broadens, so to speak, the definition of who has to report under these regulations. Not only what I call the traditional bridge from DeFi into fiat currency, but this also broadens it to what they call front-end service providers. And the IRS talked about they used a simplified layered stack of the layer one, the interface layer, people who operate on the interface layer. Now, that is the broker of the effect. The goal for the IRS is that it really wouldn't change the effect on the actual user of the DeFi product, because in theory, if they weren't using a DeFi product and they were using a traditional custody broker, they would be receiving a 1099. Well, they're going to be receiving a 1099 DA for their what they maybe thought was decentralized or wholly decentralized finance. The IRS regulations, they tried to make sure that there wouldn't be duplicate reporting. There may be some duplicate reporting, but the IRS regulations tried to compensate and avoid that so that there would only be one report on these DeFi transactions.
Yeah, this obviously these regulations caused no small stir in the industry. In fact, they were immediately challenged by the DeFi Education Fund, Blockchain Association, and the Texas Blockchain Council immediately filed a suit against Treasury the day after, basically saying that the agency had exceeded its statutory authority and had violated the Administrative Procedures Act. So we will see where that all heads, or in this new administration, if some sort of repeal might happen. But these are the regulations for now. So we're going to operate under the assumption that these are how our clients and operating companies in the space need to comply with. I think John really laid out what their obligation is going to be, the type of reporting that they're going to need to do. But really, it's going to give us a little bit more of a better interpretation of what a front-end service provider is under the law, what they need to comply with. They specifically mentioned with a wallet connect button that can facilitate the dispositions of any crypto or NFT transactions, if there's a swap feature. It was a little less clear if the regulations will extend to websites that lack the connect wallet functionality. So this might extend to ChatGPT or Google, which you can direct maybe make some of these transactions. I know that was something that was voiced in social media. How far does this extend? Is it just for these crypto sites, or are they trying to take an even broader stance, which would cause some complications there? So we have the regs. At the end of the day, they're not all that surprising. We knew this was going to come. The timing of which might be a little suspect with the end of the year and a little inconvenient for the industry with the new administration coming in, but we have these regulations in place now. We're going to help our clients report and be compliant with them.
And of course, this reporting is set to start a year later. It's for transactions beginning in January 2026.
Yeah. And there are some exceptions that were put into the regs. Several DeFi transactions are exempted from reporting, wrapping and unwrapping liquidity providers, staking, lending, and short sales, things like that. The IRS basically said they need a little bit more time to see how they're going to deal with those types of transactions. But
yeah,
your run of the mill, you go to Uniswap, you swap one token for another, make a trade. That's going to be collected, your cost basis, and there's going to be reporting from a 1099 DA.
Right. That was a very good point from Skipped It. When the IRS issued the regulations in June, they put out notice 2024-57 that listed certain exceptions, the DeFi exceptions that I refer to it, and those stay in place. The new regulations applying to DeFi brokers doesn't bring those accepted transactions in. So the accepted transactions still are excluded for the regulations as of now.
Perfect. Thanks for those. And the other news right now, which is fresh, is Notice 25.7. So I want to ask you, what is the significance of this temporary relief under Notice 25.7 for taxpayers holding crypto with brokers, and how does this affect the way they can identify and report crypto transactions during the 2025 relief period?
I think the notice is really 2025-7. It really was relief for the brokers. Well, it was a recognition that the brokers can't be accepting, or some brokers don't have the ability to accept specific transaction information. So for a taxpayer that it has an account with a broker that wants to use the FIFO method of identification for assets to be sold, that's the default and they don't have to do anything. But if they want to use an alternative method, then they needed to provide instructions to their brokers. And the IRS realized, well, a lot of brokers don't have the systems in place to accept these instructions. So how is the taxpayer supposed to use some identification method other than FIFO. Really, what this Notice 25-7 effectively means for taxpayers is they have to follow the same procedures that were set forth in Revenue Procedure 24-8, which was the end of universal wallet accounting. So if taxpayers want to use some method other than FIFO to identify which assets they're going to sell, then they need to take some contemporaneous action, which is to specify a standing order or take some of the other steps that are set forth in Revenue Procedure 24-8.
Yeah, and more importantly, this also gives the brokerages time to understand and put in place how they're going to interface with their customers to understand how they want to dispose of those specific tax lots. Have they been doing specific ID? Do they want to sell a specific portion? Do they want to do HIFO? Do they want to do LIFO? So this really just gives the industry a chance, especially if you're selling on brokerages, to just understand how you're going to interface with them, how you're going to share your records, how you're going to communicate the tax lots you want sold. So it's a good thing. It's a good relief. There were a lot of takes out there that misconstrued what this relief notice was, that this was going to delay broker reporting, it was going to delay the safe harbor. It's not that. You still had to do safe harbor. You still had to keep proper books and records. There's the DeFi reporting still in place. It's just how you're going to be able to track it and communicate that for selling your tax lots. There is an interesting concept that we've talked a little bit about earlier where you talk about this is on a per wallet basis, and within a wallet, you can have multiple addresses. In theory, you could buy your crypto on a centralized exchange, transition that to your own, cold wallet, your own self storage under the same private key, and keep all of your assets there, and not really have to worry about communicating to a brokerage because you could then liquidate via your hot wallet and then transition to a stable coin, move it back to the centralized exchange and not have to worry about this. Now, that's an interpretation you could take from just how the regulations are put out there. So that's if you want to take more of a savvy approach. There's a little bit more risk there with doing it your own custody. But all that is to say, we have better guidance now. We know what the rules of the road are. And we've already had plenty of calls with our clients talking about how they're going to comply with it, even on the individual taxpayers, how they're going to sign their tax lots and communicate with the brokerages.
Before we continue, let's take a quick commercial break to talk about something that every Web3 accountant, DAO operator, and finance professional can relate to: the chaos of on-chain data. Managing blockchain transactions can feel overwhelming when starting out. Fragmented wallets, scattered protocols, and endless spreadsheets that just don't add up. That's why I'm excited to tell you about our podcast sponsor, Octav. Here's how Octav can change the way you work. Under a single platform, Octav pulls together data from your wallets, custodians, and DeFi protocols, meaning you don't have to jump between tabs or apps. Also, you can instantly generate key metrics like wallet balances, protocol positions, and total funds by category or network. Everything's organized, clear, and ready when you need it. And lastly, if you need to share data with your team or accountant, you can export everything as a PDF or CSV in seconds. The best part? Octav doesn't just show you the numbers, it lets you add context with transaction notes and categories, making reconciliations, audits, and reporting a breeze. This isn't just about saving time, it's about taking control of your data so you can focus on what really matters, growing your Web3 organization. But hey, don't take my word for it, try it out for yourself. Head over to octav.fi/theaccountantquits and get 14 days for free with all their pro account features, and discover how Octav can transform your crypto operations today. So in the intro, I mentioned that we'll actually be going through numerous topics today, and the next topic is on staking. And for new listeners joining, I just want to provide some context on what staking is. So with proof of stake blockchains like Ethereum, Solana, and many others, holders of the native tokens can stake their assets in return for staking rewards. Most holders would not set up the technical infrastructure for staking themselves, but they would rather delegate their tokens to a validator. And some of the well-known companies include P2P, Figment, or Kiln. Now, I want to go through a very specific topic called the created property argument. So, under Revenue Ruling 2314, the IRS considers staking rewards as taxable income at their fair market value at the time of receipts, or in other words, when the delegator has dominion and control over them. There is another argument called the created property argument, which refers to the idea that staking rewards should not be recognized as taxable income when they are received, but instead only be taxed when the taxpayer disposes those tokens. Could you go through the origin of the created property argument and its current legal authority and status?
Basically, the created property argument, the property you create isn't income until you have a disposition event, until you sell or otherwise exchange it. The common example is if a baker takes a loaf of bread out of the oven, there is not income until they sell the bread. If you have this position, you really do want to talk to your tax advisor, because a lot of taxpayers personally believe, and I tend to agree, that Revenue Ruling 2023 is really not very well reasoned. The IRS has made it clear that they believe that when you validate that transaction and the algorithm generates an additional coin, that's income. But the IRS doesn't call it services. At the same time, they cite cases that are of a service provider, an accounting firm or providing services or a law firm providing services. So that revenue ruling is a little confusing. They disclaim any applicability of that revenue ruling to Section 83, which pertains to services performed, yet they cite cases that where services were clearly performed. So that's one problem I have with the revenue ruling. The IRS then goes on to say, well, you've performed services, but you don't have income if you are a cash basis taxpayer until you actually receive the coin. And that generally makes sense. If you're a cash basis taxpayer until you receive the remuneration, you don't have income. But then what are accrual basis taxpayers supposed to take out of this revenue ruling? So it's very confusing for accrual basis taxpayers. And I think the revenue ruling is written very broadly that says the income occurs when the coin is created. So I think there's a lot of problems with that revenue procedure or that revenue ruling. And so I think taxpayers could still frame an argument. The counter argument that income must be separate from the property from which it's derived has recently been discussed in other Supreme Court cases involving a realization event, where in recent Supreme Court cases, the justices of the Supreme Court have made it clear that you still have to have some sort of realization event. And I just don't see it here. I see that the creation of a coin is not income, that the two have to be separate. The income has to be separate from the property in which it's derived. So IRS guidance out there is really very thin. It's just the revenue ruling. They don't really cite cases that I find too persuasive. And there's other guidance out there still affirming the need for a realization event. So I think taxpayers could recognize the income or could still say it's created property and that it's not income until it's otherwise sold or disposed of.
And just to dovetail off of that, it's when you approach the creative property argument in general, it's good to just understand what is eligible and what is ineligible for creative property for deferred revenue recognition. Just high level, it has to be newly minted tokens. So to give an example on Ethereum, for instance, those consensus layer rewards are eligible because those are payments for newly minted ETH validators who are performing duties to maintain the protocol's operations. Those rewards are more predictable. But then there's also consensus layer rewards are eligible. Execution layer rewards are not eligible because those are not newly minted tokens. So a little bit of a nuance there. And every protocol is different. Solana, Polkadot, Near, they all have different consensus mechanisms. So you have to take a look at what is eligible, what are newly minted tokens. When you get into delegated staking, there's also some nuances there. For example, if you're going to be staking Solana through Jito, and if you're going to be contributing to a pool and you get a liquid staking token in return, that token doesn't earn SOL separately. It owns a percentage of the pool reward. So when that pool increases and the balance increases, your Jito SOL token that you had in exchange that increases in value. And that's a whole nother kind of topic for is that a taxable event? Is that revenue recognition? But basically, there's a really nuanced approach you have to take to every chain. Everyone requires its own analysis from an argument perspective. You want to take that opinion, but it's good to just understand what qualifies and what doesn't.
And staying on delegated staking, does the geography of the validator play a role in how the delegator recognizes revenue?
That's a very good question. And that's really one that the IRS has not answered at all, as far as I could tell. Most people delegating, does it matter where the delegator is located, or does it matter where the actual node operator is located? I think you could make arguments either way. That if you're making the argument, I'm just an investor investing in a protocol, my resources are located where the investor is located, so it's sourced to me as the investor. A counter argument might be is if you know where the nodes are, but if the node operator, the person doing the actual validating, is located in a particular country, maybe it's sourced in that particular country. I think the arguments are stronger that you're an investor, but you could probably make an argument either way. And again, this is assuming you're saying, okay, this is income at the time of the staking rewards.
Yeah, you really see an opportunity for some companies in the space to do some kind of regulatory tax arbitrage where they want to source that income from. In many cases, large treasuries that are using third-party staking providers that might have a good reason to source that revenue overseas or a specific jurisdiction. So it really all depends on where you're trying to source that revenue from. And there's a little bit of gray area right now, but I believe in the future we're probably going to get clarity on that. And there's a lot of arguments that can be taken to sourcing to residents. We'll see what the IRS comes out with in the future.
Before we continue, let's take a quick commercial break from our sponsor. If you're serious about running your business using crypto, you need tools built for crypto. One of my favorite apps, and yes, one that I use multiple times a month, is Request Finance. This app has been a game changer in how I invoice my clients and receive stable coins and crypto directly in my wallet. But hey, there's so much more to it. Request Finance is the all-in-one platform for crypto operations. Accounts payable, accounts receivable, expenses, and even accounting. Plus, they've got a killer multi-pay off-ramp to over 190 countries, meaning you can pay someone with crypto and they get fiat in their bank account. Request Finance connects to over 20 blockchain networks, including Ethereum, Solana, Base, Arbitrum, Near, and more. Here are some features that I love. Batch payments using your preferred wallet of choice. A single dashboard to track all invoices with real-time updates. All invoices contain the transaction hash for easy audits. But hey, don't take my word for it. Try it out for yourself. Head over to requestfinance/partners/theaccountantquits and get 2 months for free with all the pro account features. Join 3,000 finance leaders today using Request Finance and make crypto operations simpler, compliant, and less stressful. Now, when we were brainstorming to prepare this episode, you guys were very kind to send me some of the topics that are relevant for this episode. And one of them is on frozen staking rewards. So what does that mean for the listener? So on November 1st, 2024, the IRS published a memo on the tax liability of staking rewards held on platforms that have filed for bankruptcy. In this memo, the IRS concluded that the taxpayer must include staking rewards in their gross income for the year when they were received, since the taxpayer had dominion and control over those rewards prior to the bankruptcy filing. It seems harsh. So what lessons can we derive from this regarding staking on exchanges or other custodial staking providers?
In one sense, I think the consequences of a bankruptcy can be severe for people holding claims. If they did have dominion and control over assets that were frozen as a result of an automatic stay, a lot of taxpayers wanted to claim losses immediately. That, in a lot of ways, is pretty standard law that you can't claim a loss until it's recognized and until it becomes completely worthless or you dispose of the loss. So a lot of taxpayers sold their claim for pennies on the dollar in some instances, and then you can legitimately claim a loss. That particular guidance, harsh consequences for holders, but it's not really that different from what has existed in other bankruptcy contexts in financial institutions. Just because your accounts are frozen, if there was income earned before the bankruptcy, you would still have to recognize that income.
This really gets back to a common theme that everyone in crypto is well versed on is you get airdrops, you get staking rewards. Once it hits your wallet, you have dominion and control over it. You have the ability to dispose of it. In this particular instance with this taxpayer who, despite the fact that his tokens were locked because of a bankruptcy where the exchange where he was staking those tokens, he was still liable for that tax bill on the revenue he received. So you just need to be mindful. At the end of the day, these are mutable transactions, and when you have ownership of them, you have to be able to bear responsibility for your tax burden.
Now, moving from staking to airdrops, and again, for the listeners, if you're not very familiar with what an airdrop is, basically it's the distribution of tokens directly to the user's wallets. Usually these are for free or in exchange for performing specific tasks on the blockchain or protocol. Some of the very famous airdrops before were from Uniswap, ENS, Optimism, Arbitrum, 1inch, and the Bored Ape Yacht Club NFT. Can you walk us through how airdrop recipients should approach valuing airdrops when there's no public market, and what factors might justify assigning a value instead of just defaulting to zero?
Sure. I think in most instances, and this is where I talked about like the common sense rule, there is no blanket rule, as you said. If there's no public market, it doesn't mean something has no value. A lot of times it's a good indication that it has no value. But if something sounds too good to be true or is not realistic, I'm sure before there was a public market for a Bored Ape coin, I'm sure you wouldn't have assigned your rights to that to me for pennies on a dollar because you anticipated that it did have some value and maybe is discounted. So, my only caution to people is to not draw a blanket line that says, oh, there's no public market, so I have no value. It might be nominal value, it might be very small value. And so it's always, yes, you have an accounting issue unless it's just so onerous. It's always safest to account for it and assign some value to it. At least then you've established the receipt of it, you've established a holding period, and should the coin go up in value at some later point in time, you sell it a few years later, you'll at least be able to, you'll have gain, but it might be in more of a capital nature than considered a short-term gain.
Yeah, there's also instances where many of our clients, many groups out there are providing services to a foundation or a labs group before the token is released. Whether you would classify this as an airdrop is another question. But in many cases, if you're swapping tokens for services that have been rendered between two disinterested parties and there's no public price or market for those tokens, then the presumed value of those tokens that are going to be received is the fair market value of those services rendered. Again, you might not qualify that as an airdrop per se, but in some instances, you're actually being paid these tokens that are dropped to you for services, and you can take into account the value of those services.
Interesting. Does that happen a lot in practice? The last example you provided?
Yeah, more than you would think. There's a lot of consultants, there's a lot of groups out there, trading entities that form partnerships and agreements with some of these foundations and labs groups, whatever advisory or consulting services that might be, and they're rewarded in kind for those tokens. Typically around the same time these airdrops occur when the tokens are released. So it happens quite frequently. So then it comes down to an exercise of what is the value of those services, and that would dictate the fair market value of what you'd be receiving in kind for the tokens.
Perfect. Now, moving from airdrops to token migration, another topic you wanted to touch on. Recently, there's been the DYDX token migration, for example, from Ethereum to Cosmos. For the listeners, what's like the tax liability when such token migrations occur? How does it affect their tax bill?
I mean, it really depends how conservative you want to be. Token migrations are commonplace. They happen all the time. Maple just went through one. Polygon just went from Matic to Poly. And DYDX also moved from Ethereum to Cosmos. These migrations are going to continue to happen. In some cases, there's no material change to the token. In other situations like DYDX, there's an actual bridge where you have to go and swap out your token from one to the next. If you are conservative, you might pay taxes and consider that a taxable event, and it just when you swap for the new token. Or you can take the position that it's not taxable and you should not be taxed on swapping from one token to the next. I've talked to many clients about this specific issue. John and team have taken opinions for them so we can carry on the conversation on where we approach it from a tax and legal basis.
You really have to look at what does the token represent before the migration and what does it represent after the migration. Yes, the technologies are different. It's operating on a different blockchain, but are your rights to the ecosystem, have they really changed substantially? And has there been a counterparty to the transaction? In the simplest format, a lot of times you can think of wrapping a token as really just like a token migration as well. And people, a lot of times people think, well, if I'm just wrapping my ETH or if I'm wrapping my Bitcoin, it's really the same thing. It's just I'm changing it so that it can operate somewhere else. But the amount of value it represents hasn't really changed. So you can look at it that way and really come up with an argument that I haven't really changed my bundle of rights as represented by that token.
And as I explained before, you have to dive into all the details of how that migration happened. What was the allotment of tokens across the community before the migration happened? What was the governance process and the voting like to approve that migration? Are you moving from one layer one to another? Or are you just changing the name of the token? There's lots of different token migrations out there. But to defend a position to the full degree and write up an opinion and a memo on it, it takes quite a bit of analysis to dive into the smart contract layers, the bridge, how you're swapping that token, the market for either token after it happens. So it's fun stuff to dive into.
Yeah, it's very similar to wrapping and bridging, like you just alluded to. And for bridging, for example, a conservative tax treatment would be that there is no tax impact.
No, the conservative tax treatment might be that if you had a lower basis in the asset and you're bridging to a new basis to recognize the gain because you've moved from ETH to wrapped ETH or something, and you would recognize a gain. Conservative, that means you're recognizing the income and you're not trying to defer your gain. But I think the wrapped coins, now you can't always judge by what the information reporting regulations, how that IRS treats that substantively as income. But the IRS also did call out in the information reporting regulations that they weren't really interested on information reporting for wrapping situations. That was one of the instances that they exempted out of the new information reporting. So I think a lot of the indicators are that you're just changing the nature of the mechanics so that this wealth or that this asset that the token represents is operating on a different platform. So there's really no change in your total rights, just in the technology of the token itself.
Perfect. Thanks for clarifying. And my bad for just confusing between a conservative and aggressive treatment. Now, I want to go through regulations in the US. John, with your extensive experience at the IRS, can you share what it's like when there's an administration change? How does the new leadership impact the development of future guidance and regulation specifically for crypto?
I think at the highest level, there's maybe a push to look at things differently, and they definitely can change the direction. But the U.S., especially the federal regulatory regime, really requires notices. First of all, it requires to follow the law, to make the law clear. It requires a notice and comment period. The Supreme Court has recently issued some opinions very critical of the IRS regulatory regime as steering too far away from the actual language of the statute. So I know that there's talk about a change in administration and definitely a new attitude towards digital assets. But as far as the tax regulatory framework, there's a lot of structure in place, guardrails in place by the law, by Congress and the courts, that it's really difficult for just one branch of the government to unilaterally alter the direction without agreement from Congress as well.
Some states in the US have taken initiatives to regulate crypto. I want to ask you if there's a state today that stands out in terms of regulation that they've enacted for digital assets and maybe why.
That's a good question, John. I'm not sure, I'm not sure about that. Do you have?
Yeah,
Is there?
no, I'm sure there's so many different ways that they can run. Some states are, and it's definitely, some states are definitely more aggressive as far as sales and use. Some states are much better at defining a token that recognize, is this a membership to a club, or is this token subject to a sales tax? Is this property that's being sold? So states, it is difficult because you do have the local state taxing sales tax regimes, as well as most of the states generally follow the IRS as far as the income tax character is concerned, but the sales tax, sales and use taxes, can be very different.
Yeah, when you talk about state regulatory bodies like the NYDFS from regulating trust companies, that's a whole different arena where states do vary on their regulatory stances. From a tax perspective, as John alluded to, sales and use tax is pretty commonplace. I think where you see some areas where some variability is around nexus. Like if you have a distributed workforce and you have employees maybe offshore, some in the United States, states like California and Oregon, just by having one employee there gives you a permanent establishment, gives you nexus in that state for filing requirements. Every states are different as far as what establishes an establishment of a company. So those are things we work with on our clients as well, who have a distributed workforce and looking at employee compensation and how they structure those things with EORs and things of that nature. So,
Perfect. Thanks for sharing. I said in the intro, RSM is a returning guest. So I actually had Jay Schulman, the national leader for digital assets at RSM in December 2021. So it's 3 years already. Back then we had discussed like NFTs. NFTs were very hot, but back then we had discussed DAOs, career opportunities with blockchain. So I want to ask you if you could share with the listeners an overview of the services provided today at RSM specifically for digital assets.
yeah, I mean, for those who are not acquainted with RSM, we're the fifth largest CPA firm in the United States, we're top 10 globally. So that means we are an audit firm, we're a tax firm, an advisory firm. Everything we do in the traditional sense, all the services we provide to our clients, we can do for digital asset clients, whether that's financial statement audits, assurance services, SOC reports, tax advisory, transfer pricing. And then on the advisory side, it's everything from implementing an ERP to doing management consulting, transaction advisory. Everything we do for our clients, we can do for our digital asset and blockchain enabled clients. It just takes a little bit of nuance to understand the technology, the transactions, the accounting, the tax treatments. But really, it is a list of 100 or hundreds of different services we provide to our clients.
What would you say was like going back a couple years, like I don't know, 2017, 2016, at the beginning, when you first started out providing these services, what was like the most difficult in the beginning, the challenges you had to overcome, maybe some proprietary tools you had to develop in-house to do auditing, for example, for digital assets. But yeah, we go back in time.
Yep. Anyone operating a company in the space or a fund understands there's more of just a premium you have to pay to get really good services. Even just the compliance services like the filing and the audits, because you have to understand how are these digital asset transactions happening? What are their accounting treatments for GAAP and for tax? And then for audit, especially, how do we verify the accuracy of these transactions or of these holdings so that your bookkeeping entries and your balance sheet are accurate? And to verify some of those things, you have to go and get verifiable third party data who run their own nodes and are SOC compliant. So yeah, to be a provider in this space and a vendor, you have to be able to understand the technology, you have to understand the tools, and you have to stay on top of the regulations from all the different regulatory bodies, from FASB and the AICPA to the IRS, so you can just serve your clients well. So it has been, I think, a journey for all the CPA firms in the space from 2009 when Bitcoin was released till today and all the advent of all the different chains and technologies. So yeah, it's been a journey, I think, for everyone in the space.
Skip, for example, you've been working at RSM for more than 5 years. During this time, is there a project maybe that you're very proud of to have worked on, or something that it really enhanced your understanding of the space by working on this or that client?
Yeah, even prior to coming aboard to RSM, I was just involved in the crypto community. Was an investor, was an evangelist, would attend conferences, was very just keen on the technology. Getting the opportunity to come and work in the industry from the service provider perspective, from the tax and accounting perspective, has been really fascinating. You get to speak to a lot of different companies, get to help them solve really critical challenges in their growth, get to know these founders and these companies on a really intimate basis. I think just my proudest moment is helping to build a really successful practice here at RSM. We have north of 350 clients in the space today. We do a substantial amount of revenue for the firm, and really being able to just grow a practice, create a brand, provide really good client service, and help the industry grow in a meaningful way and legitimize a lot of the industry's operations. I think that's the fun thing you get to have as a CPA firm is most of our clients are coming to us looking for assurance or audits or tax, and they're looking for a service provider they can have confidence in that knows their industry, knows their business model, knows the technology, and being able to grow a reputable brand in the space, I think has been really fun, really rewarding.
I also wanted to ask you how you train employees on blockchain at RSM. I went on your website and there's a link called spotlight.rsmus.com. I was very impressed with the amount of courses that you have there for your employees. There's a lot of courses on blockchain. So, yeah, I just wanted to ask you how the work like you've been doing on upskilling the current employees to work in the digital assets department.
Yeah, I know this is something you're particularly passionate about at the Accountant Quits. You guys have some fascinating curriculum for upskilling in the space. Same, we have an entire educational division of our blockchain practice that's just dedicated to the curriculum, the upskilling, and the training internally of our employees. Most of the folks that have come to work within our practice came from other divisions, came from audit, came from tax, came from consulting. Yes, they had the bug of being into crypto and being into blockchain, but we've done a fantastic job of enabling our workforce. And we have different levels of curriculum. There's a 101, a 102, a 103 course. I know some of our professionals just got back from trips to Europe and to Cayman, where we've had some collaboration with our alliance members and our alliance firms to upskill internationally on their capabilities to service the blockchain space as well. So that's definitely a big part of our practice and big part of the firm's strategy is just upskilling our workforce to be confident to service clients in the space.
And if there are people listening who would like to join RSM, what's like the best, or join the digital assets department team, should they just go to the careers page and go through the process there, or is it different?
Yeah, I mean, there's certainly you want to look for whatever roles are open. But if you are interested in working for RSM or another firm in the space on their digital asset practices, reach out to myself or John or Jay Schulman or Bennett Moore, who leads our practice.
Now, there's a last question I want to go through. I mentioned I interviewed Jay Schulman in 2021, and actually, the title of that episode was Where to Pay Attention to Blockchain in 2022. So, I want to end this episode today by asking you for this year, 2025, what are you currently looking forward to in the Web3 space? Can be anything from regulation, new guidance on for the from the ISPA or the IRS, or what the new Trump administration brings.
John, you want to start on that one?
I think the information reporting, although it doesn't happen until the end of 2025, one of the things that happens whenever the IRS implements information reporting is a change in taxpayer behavior. There's a ripple effect. And I'm really looking forward to seeing the different activities. I think a lot of taxpayers will use this opportunity to get their subledgers in place. So I'm looking forward to the kind of the changes both in on the taxpayer behavior and really from the IRS and enforcement perspective of what the effects of this information reporting is going to be, how it's going to change the ecosystem, because I think it will have effects. I'm just not exactly sure what. So.
Yeah, I mean, I'm very excited for the industry moving forward. I think some of the drag that's been put on the industry from the lawsuits across the industry, I think if some of those were to like lift, it would help a lot of the companies operating the space. It would encourage more entrepreneurs to build more companies, to start more companies in the United States, to receive funding. We'll see what happens between the CFTC and the SEC, where the industry gets regulated. Certainly, the IRS is going to play a big part on the tax regulations moving forward. I think everyone's hopeful for a more favorable Trump administration, who obviously are a little more favorable towards the industry. But there's also really exciting things. The advent of stable coins, their market cap, I think, is over 200 billion at this point. How that helps to strengthen the US dollar, how it gives access to the US dollar overseas, the payment networks, I think that's going to be a compelling area. Everyone's always talking about the cross section of AI and crypto and enabling agents to be able to trade their own wallets. Those are going to be big parts of it. But I think overall, what you want more than anything is to encourage entrepreneurs and builders in the space to be unfettered by unnecessary lawsuits or regulation. And I think that's where we're heading, so that people who want to have a great idea and want to build something in the space, want to build an application, build a company, I think we're going to get to a better environment where they're going to be able to do so in a more conducive fashion in the United States. And that's really what's going to drive innovation in the sector. That's what's going to drive capital creation and all the fund price appreciation that everyone loves. So,
Perfect. John and Skip, thanks a lot for your time today. Thanks for being so generous with your time. And also thanks a lot for helping me to prepare this episode with providing suggestions for topics, relevant topics to be discussed. There's a last question that is like a tradition on this podcast. Before the guest leaves, I always like to ask them if they have a favorite quote or a maxim that they live by. Would each of you have one?
you want to go for it, John? Looks like you're thinking
Oh,
about it.
I'm such a boring. He returned his phone calls. That's my quote or maxim.
He who returns the phone calls?
I no, he returned his phone calls. I returned my phone calls. That's what I live by.
It's a very cliche one, but life is short. Like, do what you love. I enjoy working in the space. I enjoy working at RSM. I get to work with brilliant people like John and everyone else that's in the blockchain practice across the firm. So life is short. Do what you love. Crypto is a fascinating space. I love working in it.
You mentioned earlier if people want to reach out to you, what's the best way to reach out to you, Skip and John?
Yeah, you missed my email, skip.carlson@rsmus.com, or my Telegram handle is skip_Carlson. You have any questions about anything accounting, tax, crypto related as far as CPA world goes, feel free to hit us up.
And I'm john.cardone@rsmus.com.
Perfect. Well, thanks a lot to the both of you for your time today, and we'll be in touch.
Thank you.